Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today we'll talk with Gary Mishuris. Gary is a value investor. I see him once a year. We have a great time together. He's a very thoughtful investor. Can't wait for you to meet him. In the mailbag today, gold, and more gold, plus a longtime listener rants back. And remember, you can call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my opening rant this week, investors are too comfortable. I know it sounds crazy, but we'll talk about that and more right now on the Stansberry Investor Hour. So we're in a bear market, and Dan is saying that investors are too comfortable. Like, how could that possibly be, right? With stocks down, bonds down, inflation up, how could it be that investors are too comfortable, too complacent, not concerned enough? That's usually the sort of thing you say, at the top when stocks are trading for, exorbitant multiples and bonds are at 0.5%, in the 10-year bond. Here's why I say this. I found an indicator, a statistic that it's an indicator that was created in the 1990s by Jeremy Grantham and Ben Inker. Jeremy Grantham is one of the co-founders of a firm called GMO. And you can go online at GMO and read their research. And you can read, they had a little piece about this indicator, and it's called the comfort model. And it's just a way of looking at price to earnings ratios of the overall stock market. And it tells you how comfortable investors are with current market conditions. And then you can sort of extrapolate and say, well, should they be this comfortable or shouldn't they? And if you read their little article on the comfort model, they sort of explain it to you. They say, the model is based on the simple premise that the conditions which make investors comfortable are high profits, stable economic growth, and inflation of around 2%. Right? So the higher the profits, they say, the more stable the economic growth, and the closer inflation is to 2%, the more comfortable investors are. With greater comfort, investors are more likely to pay a higher multiple on the market and vice versa. So when they're less comfortable, they're only willing to pay a lower PE for stocks, right? Now, and it's important to note that they're using the cyclically adjusted PE ratio of this S&P 500. Okay, it's called the CAPE ratio, and it's adjusted for inflation, among other things. So the point at this moment in history is that today's reading on the GMO comfort model just suggests that investors are too comfortable. Like, they should not be willing to pay a CAPE ratio of 30 times, or 29 or 30 times is where it is these days. They should, according to the model, according to GMO's, reading of their model, the current condition is like, profits are down, economic stability is not great, and inflation is 9%, not 2%. Those should not be comfortable conditions. And according to them, investors shouldn't be paying more than 19 times CAPE ratio for the S&P 500, but they're willing to pay 29, 30 times. So they're still too complacent. Like, we've had this brutal, record-breaking first half, literally the worst first half for the S&P 500 index since 1970, but the worst first half, the worst 6 months for the 10-year U.S. Treasury since 1788. Not kidding. It's been horrendous. And, of course, some people, they want to point to the popular the popular sentiment indicators, the AAII, the American Association of Individual Investors, is one of them. That's one of the popular ones. But that's a sentiment survey. They're just asking people how they feel, right? Are you bearish? Are you bullish? And of course, they're more bearish now. They're more than average bearish, and they're less than average bullish. So people say, "Wow, people are scared." And if you look at who is it? I guess CNN has that fear and greed indicator. It's in the fear mode, right? So a contrarian would look at all this and say, "Well, investors are fearful. Stocks must be cheap. Let's buy them." And I think that's too glib. I also think the sentiment indicators are they're too volatile. They're relatively worthless most of the time. So I just I've looked at them and watched them over the years, and I've quoted them and I've offered them as, contrarian evidence, and it just never seems to work out. They're just not that great. Every now and then I'll see a really, really serious extreme, but other than that, I stopped following them like last year. I don't look at them anymore. But this comfort model is different because it's based on the price earnings ratio of the market. So it's how much people are willing to pay for stocks. That means a lot more to me. That's in the market. That's not just what somebody says in response to a survey, right? It's what they're doing with real money, right? So that means a lot more to me. And I think it's true. I think people are too comfortable and complacent. And a recent thing I saw that sort of backed this viewpoint up is that um, the CEO of the National Association of Home Builders went on TV. What's his last name's Howard? I think it's Jerry Howard. And he was talking about um, the simple fact that housing is one of the best leading indicators. And he didn't say that, but he said housing has led us into every recession since World War II, and it's led us out of every recession since World War II. So it has been a pretty powerful leading indicator of recession. And, the prices are starting to fall. And he cited a bunch of statistics that say, unless something changes, we are headed into a recession, basically. That's what housing is telling the National Association of Home Builders CEO these days. So, I think that if investors are willing to pay a lot, we're headed into a recession. Interest rates are up. Inflation is up. I mean, this. Maybe I'm just being too simple-minded about all this, right? Because everybody knows housing is the leading indicator, and everybody knows about inflation, and everybody knows all the things I'm telling you. The only thing I would say everybody doesn't know is that stocks aren't really cheap. I think a lot of people think they are cheap, and I don't think they are. So, be careful. I wrote about all this in my latest Stansberry Digest. If you're a Stansberry subscriber, it was the first part of my Stansberry Digest. And then I went on to talk about a bunch of stuff that maybe we'll talk about next week that's a lot more complicated. But just put this, put this thought in your mind and keep it there. I think investors really are too complacent right now. They're paying too much. Still, the CAPE ratio it peaked 3 times before 3 enormous bubbles in the last century, 1929, 2000, 2007. And it's now just back down to the third highest one, 1929. And I don't think the fact that 1929 is nearly 100 years ago is a problem. Some people say, you can't compare that market today. I think you can. I think you can compare all the massive bubbles to one another because we go into them, everybody's optimistic. They run stocks up to unseen heights, and then they plunge, and we get a bear market of 2 years. Well, put it this way, we've never come out of a massive bubble with, a little 6-month, 20, 30% drawdown like we've seen in the S&P 500 and NASDAQ. I've said that before. I'll say it again and again and again until the message comes across. But, I don't think this is half over. And I think we need to be real careful about what we're buying nowadays. I'm going to leave it right there. And I'm really excited about this week's guest. I've known him for years, but I'm finally getting him on the show. Let's talk with Gary Mishuris. Let's do it right now. A new financial crisis has developed recently in America, says stock market expert Matt McCall, and the trail of destruction it could leave behind will look nothing like what you might expect. In fact, McCall warns nearly 40% of the elite publicly traded companies, brands you've known and used your whole life, could go bankrupt because of a strange market event he calls the flippening, wiping out thousands of investors' fortunes. McCall has written a brand new report explaining exactly what the flippening is, how billionaires are already profiting from this big event, and what you should be doing to prepare as well. To get a copy of his new free report with all the details, simply go to mattflipreport.com. Again, that's mattflipreport.com for a free copy of our report. Time once again for our interview. Today's guest is Gary Mishuris. Gary is the managing partner and chief investment officer of Silver Ring Value Partners, an investment firm with a concentrated long-term intrinsic value strategy. Prior to founding the firm in 2016, Mr. Mishuris was a managing director at Manulife Asset Management, where he was the lead portfolio manager of the U.S.-focused value strategy. From 2004 through 2010, Mr. Mishuris was a vice president at Evergreen Investments, where he started as an equity analyst and assumed roles with increasing responsibilities. He received an SB in computer sciences and an SB in economics from the Massachusetts Institute of Technology. Wow, I didn't know you went to MIT. That's cool. Maybe we'll talk. Gary, welcome to the show.
Well, thank you so much for having me. I really appreciate it.
So you went to MIT.
I did. I really enjoyed it.
Oh, you bet. You bet. So, I mean, does one study, value investing and economics at MIT, or what did you study there?
Yeah, no, I think MIT is actually on the other end of the spectrum. It's quite quantitative. I think what I learned from MIT is very rigorous systems level thinking, right? Because as an engineer,
Hmm.
you can't, wing it, right? As a fundamental value investor, you can make whatever you want up, and time will tell. But if you don't do it right, your code will not compile and the program will not run. So you have to do it systematically and rigorously, otherwise it just won't work.
All right. Yeah, we've had a few folks on the show who started out in scientific disciplines and said much the same. It's the rigor and the fact that, as you say, in the sciences, things either work or they don't. And there's a lot more leeway in finance. So how did you make your way to finance from MIT?
Sure. So, this was during the tech bubble in that circa 1999. And I was dabbling in tech stocks, kind of thinking, oh, I'm smart. I'm studying economics and computer science. I can figure it out. And I think I was lucky to have invested my meager savings in the only tech stock in that period that went down. And I say that because, had I like actually made money together with 99.99% of other people, I would have gotten the wrong lesson, right? That like you do no work, you guess a little bit, and you get a lot of money. And then right around that time, Warren Buffett came and spoke on campus at the Sloan School of Management. And I heard the name. I didn't know much about him. And he wasn't, in favor back then. 1999 wasn't his peak year of popularity, let's just say. And so I went to listen to him speak, and here was a guy talking about long-term, intrinsic value, competitive advantage, and stuff that's second nature now, but back then was kind of new. And immediately took, and I stopped fooling around gambling in tech stocks, and I started reading about value investing. So that was kind of the origin story, if you will, of my passion for investing.
Okay, so let's fast forward to 2016, and now you founded your own value investing fund. How big of an organization is it? Is it just you? Are you a solo guy, or do you employ a large staff, or somewhere in between?
You're looking at the organization right now. I'm right here. It's me.
All
I
right.
do have an outsourced CFO for like administrative, for like operation stuff. I have some remote interns that help me out occasionally. But I've never set out like, look, I started my career as Fidelity. I worked at very large firms, and I've just come to the conclusion that for me, in the way I practice concentrated value investing, I don't want a big team. There are pros and cons. We can get into it. But what I realize is these committees or these kind of hiring the Harvard MBA who wants to make decisions 3 years out of business school, never seeing a down cycle. That is not to me the best way to manage money. So given what I do, I don't envision there's going to be much of a team. Maybe a couple of junior analysts down the road, but I believe that this fits very well with my approach.
All right. It sounds like you found your spot. How concentrated are we talking here? Let's get into it a little bit.
Yeah. So, I would say 10 to 15 positions would be typical. My position size ranges from 5% for a small position, 10% for a medium, and then 15 at cost for a large position. I would say that latter sizing is unusual. Like a lot of things need to line up, not just valuation. It would need to be business quality and people quality as well, and balance sheet quality. So I would say the goal there is to make sure that no one decision can really sink the ship. And I know there are people who disagree and they say, a dozen investments, that's not that concentrated. I have half my portfolio in my biggest position because I have conviction. Well, I've been humbled many times. I've done this for over 2 decades, and I've always seen people. It's good to have conviction, but you also need to make sure that it's your process over time that drives your outcome, not any one decision. Which, no matter how good you are, you're gonna get wrong some of the time.
Yeah. Yeah, when I hear that, I do cringe a little bit when people say they've got half or even like 25, 30%, I just start thinking, "Man." I'm thinking about a particular fellow whose name I won't
Right?
mention, but, it was some massive position in an oil and gas stock
Mm.
when oil prices were way up, and, it just, of course, he blew up and had to, liquidate and everything, but it doesn't sound like you're gonna allow that to happen.
No, I
Okay.
try not to, that's for sure. But I mean, one of the reasons I have that mentality is when I was at Fidelity, there was a very senior analyst on the verge of promotion to portfolio manager who sent out a research note to the whole department. And the note basically said, I think it actually verbatim said this: if you don't buy this stock, you don't deserve to be a portfolio manager, which is a pretty bold statement, right? And of course, the
Yeah.
punchline, or I'm sure you're guessing the punchline. It turned out to
Yes.
be a fraud, right? So it's not that he was wrong. It looked so amazingly good, and like you have, it
Yeah.
was so good that it was just not true, right? I mean, obviously he didn't become a portfolio manager, and no one has heard of him again. But that was just a very vivid early example where conviction good, stupidity and overconfidence on a massive scale not as good.
Right, and I think the other point deserves to be made too, right? He could have survived that, right? If he had, sort of operated in a more measured, risk-aware fashion, right? If he had just said, "Well, maybe, if you don't buy the stock, you don't deserve to be a portfolio manager," but maybe he also could have said, "I think there's something here. This might warrant a small position," right? So, in other words, you can buy frauds and they don't have to blow you up,
Right.
right?
No, and I think that's right. I think, we can get into it later, but I'm a big fan of behavioral finance and just being aware of the various biases that we have. And I just think that like there was such sheer arrogance oozing from his note that it wasn't that he got it wrong. It was just the misjudgment of not knowing the
Mm,
limits of your insight. That was the big, I think, issue.
yeah. Yeah, it's a lack of risk awareness. It's bitten a lot of people. It's bitten me, at various times in my life. I had my, you had your 1999 moment of being wrong. And, I've had my moments as well. So before we get in I wanna get into the behavioral stuff before we get into, the kind of companies you like to buy and all that,
Hmm.
because you've spoken about this before in that part of what you do. The other stuff,
Hmm.
it tends to sound very similar, even though everybody's very proud of how they've, chosen which companies they buy and everything.
Right.
But I think this sort of makes you stand out in my mind, as an investor. It's one of the main reasons I wanted to have you on the show. So let's talk about that. You know, are there is there an important list of principles that you've learned from studying behavioral investing, for example?
Sure. Yeah. And I think, well, at a high level, a lot of investors are very eager to play behavioral offense, right? Because if you think about it, active investing very much says the market is wrong at least some of the time, right? And we can take advantage of it. Now, why is the market wrong? Well, people make mistakes. The mistakes are systematic enough for me to find them, right? That's offense. You're trying to take advantage of the mistakes others are making. And I think too little time is spent on behavioral defense. And that's kind of being, saying, okay, yeah, the market makes mistakes, sure, but I also make mistakes. And unfortunately, they're also systematic. So it's not like, oh, I'm just like once in a blue moon making a mistake. So you have to have systems in place to guard you against the very same things that you're trying to take advantage of on the other side. So I'll give you an example. The very common mistakes might be anchoring, right? And confirmation bias, which is a deadly pair. You buy a stock XYZ, you have a thesis, think it's worth 200, you buy it for 100, so you bought it for half of what you think it's worth, and you have a thesis. Now your mind is going to make sure to sweep under the rug any evidence that your thesis is wrong, and it's going to anchor on that 200 number, right? You want that 200. And very frequently, people in value investing talk about value traps. Jean-Marie Villard once told me there's really no such thing as value traps. It's just you getting it wrong. And I think he's right in the sense that we latch on to, oh, this is business worth 200, and we latch on to our thesis. And so the question is, how do we? And here's why, by the way. Yeah. So if you think about it, you start as a beginning value investor and you observe sell side analysts who whiplash their price targets willy nilly. I think of the sell side price target as a carrot in front of the donkey that's on a stick, right? It moves as the donkey moves. No, so they say, well, I'm going to recommend, my boss wants me to recommend this stock or whatever, right? So the price target will be 25% or whatnot of the current price. And I'm just going to adjust it for frivolous reasons no matter what happens, right? So that's like the behavior that the value investor rebels against. And they say, oh, no, I'm not going to be like that guy. I'm going to have conviction and I'm going to stick to my guns, right? And that's good, but only good if you're right. If you're sticking to the wrong things, then that's not good. So then the challenge is, how do you not become like the sell side analyst who's like going all over the place based on whether the stock is going up or down? But how do you actually make sure that you still are open to opposing points of view? So here's a few things as an example. So I have a thesis tracker that color code in my one of my spreadsheet, and this is very simply every quarter for each investment. I code each cell from bright red to bright green. So there's 5 levels: bright red, orange, white, light green, and green. And bright red means that quarter was strongly disconfirming relative to the thesis. By the way, no excuses. Doesn't matter if it's a recession, doesn't matter if it's COVID. So there's no judgment. And the reason to not allow judgment, even for one-time charges, one-time charge doesn't matter, still gonna get penalized. And by the way, it's not against quarterly estimates, but it's against kind of my base case trajectory for the business. So if I think this business should have 10% operating margins and grow at 5%, organically, let's hypothetically say, and now this company comes in at minus 5% organically, it's going to get a red box for that quarter. Now, there might be a perfectly sound reason for why the one quarter is not representative of the long term, but I still get to look at that red box. And I have certain triggers. For instance, if you get a single red box, I get to rebuild the model and start from scratch. If I get 3 orange boxes, meaning mild underperformance in a row, I get to rebuild the model. And in each of those scenarios, I'm not allowed to add to the position. So this is kind of like tying yourself to the mast in the Odysseus story, where I know my tendency as a value investor is to double down, right? Oh, Mr. Market, you're going to argue with me. Well, you're going to take my stock from 100 to 50. I'm going to put more money in to show you, right? That's a dangerous mentality because the idea isn't to win. The idea is to be right on average over time. And so I put these kind of checks and balances to guard against what I know are my own tendencies, which I have just like anyone else. And I think the advantage then is if I have hypothetically the same tendencies, but I'm more aware of them and I have more systems to prevent me from damaging my portfolio through the behavioral mistakes I might make. I'm not going to catch all of the mistakes, but if I catch a good percentage of them, I'm going to have an edge in that area.
Interesting. So, just to be clear, like, you could put a red box on there and the stock could be up, let's say, or you could put a green box in there and the stock could be down. It's not about the performance of the shares, it's about the performance of the business as revealed by quarterly reporting.
Right. And I think, a lot of like you said, all value investors sound the
That's
same. I'm sure you talk to a lot of them. And I'm sure one of the favorite things that you've been told, is, hey, we're not worried about volatility. We're not worried about mark to market risk. The
oh, yeah.
values in our portfolios have not changed. Like I read a lot of letters and I read it all the time. And I think that's true if they haven't changed for real. The danger is that the manager, someone like in my shoes, is sitting on a bunch of unrealized losses. Their loss aversion, which is another well-known behavioral bias, is preventing them from realizing those losses. So they're, as Peter Lynch used to say, cutting the flowers and watering the weeds. They're selling their winners because it feels good to lock in the win, and they're nurturing their losses, waiting for them to come back. And so what they're saying to themselves and to their clients is like, hey, don't worry, it's just mark to market. The values haven't changed. But I think the reality is the values change all the time. Like it's not like the value is not a certain thing. Like because people like the certainty, like this pen is worth 100. But the reality is it's both uncertain, meaning it's a range, and it changes over time, right? Like think of a mine, right? You have 10 potential mines. Either it has a $100 of gold or not, and there's a 50% probability of each mine, right? As you explore the mines and you realize that the gold is there or not in each mine, the value of that 10 mine enterprise will change because what started as an expected value becomes an actual value based on how much gold is in the mines, right? So I think that you have to be sufficiently flexible to adjust to reality as it changes, but have sufficient conviction that when the reality, the evidence is there, but the market disagrees, you don't fold to the market's pressure. And that's the delicate balance.
Right, and it's tough, isn't it, for a fundamental investor because let's face it, it always turns out like, the market knows before you do, right? And then you have to the market knows, it sends the price of your stock down, 30, 40%, and now you're having to look at the information that has been revealed and make a decision after that decline. It's not easy. It's not easy.
No, and I have a great story from early in my career at Fidelity, where I was an arrogant little, punk, a 23-year-old, whatever, who thought he knew something about value investing because he read a few books. And I kind of, there was a
Oh,
company
Poly
called
One. Yep.
Poly One. The ticker was POL, and yeah, I mean, it was a plastics compounder, and I covered specialty chemicals as my first assignment. And I remember we owned like $100 million of this thing at Fidelity, which was nothing for Fidelity, by the way, but for a young kid with a negative $10,000 net worth, net of the school college loans, that was kind of a lot of money. And so I recommended we buy it at like 12. I visited them. The CEO at the time was a very nice Harvard Business School educated man, sharp suit, everything terrific. He told me this cross selling strategy, how they were going to grow the business. It was awesome, right? And then the stock started to slide, went from 12 to 10. And I'm like, great. Volatility is our friend. Let's go. I went to all the portfolio managers because like that's what we were supposed to do. Analysts to go to the portfolio managers, try to convince them to listen to their recommendations internally. So I said we should buy more. And some people listen, some people not. And I went to 8. I'm getting a little nervous, like going from 100 million to like 70 million or so isn't pleasant. But I'm like, oh, let's buy more. And one grizzled veteran, the guy who ran the Valley Fund, said, let's call them, Gary, let's call them. And the stock with that point was like at 7. So we call them, and from the questions, from the answers in the body language, it's very clear that they're going to miss the quarter, that the quarter is weak. But again, there goes Gary again. It's like, guys, we're not playing the quarterly game. We're long term. We should be focused on the value. The value is $20. Now this is a great bar. Like I'm sure you read a lot of this stuff, right? Uh, and I didn't realize at the time how awful I sounded to others. But and like for them, this is like Fidelity, so they're not concentrated. They have like 30 basis point position. So like, fine, we'll humor this guy, whatever. But most of them held on. And then I remember this vividly. This was December 23rd. This or some the day before Christmas Eve. No, they didn't miss the quarter. They pre-announced like the day before Christmas Eve. Which, by the way, if anyone pre-announces the day before Christmas Eve, you know it's for real. It's not because they're missing it by a penny, right? They hugely cut guidance, eliminated the dividend. The stock was down 50% in a single day. So I wanted to hide under my desk and cry, but I made it around to the portfolio managers, and one guy who wasn't particularly nice about it, he said, Gary, are you sure you know what you're doing? Why don't you go home and reread Warren Buffett, take the rest of the day off? And I actually listened to him because I literally felt sick to my stomach. By the way, there's a corollary. Eventually, we bought back more. At that point, it was trading at such a distress level that it was an overreaction, and we did okay in the end. But that was a very serious early lesson that, first of all, arrogance can be deadly. But the other thing is, there are times when the market, I'm not a technical analyst and I never will be, but to basically assume that price action means nothing is essentially saying that you have all the knowledge in the world and nobody else could possibly know anything you don't know. And that's just not the case.
And all that price action after you do all your fundamental work, that all happens in the future and you don't have any control over it. And, you can know the business inside out, upside down, backwards. By the way, as I recall, being involved with Poly One, I was writing a newsletter about, I think it was about small cap stocks a long time ago. So I feel your pain on that one is the message there. And on cyclical stocks in general, I've learned a huge lesson. I've learned it probably too many times, but I believe that I have finally learned it. And so, my question then for you today, running a concentrated portfolio, is there a place for cyclical stocks in what you're doing today with, 10 to 15 positions?
Oh, absolutely. I mean, I think those are my favorite. I guess the way I think about it is, if you're a value investor, you have to think about what are the patterns of mispricing that you're trying to exploit. Why are they going to reoccur? Right. And cyclicals. So why does what's happening with a cyclical? Like, let's take a deep cyclical. There's no growth cycle to cycle. And let's say it loses a dollar, at the trough, it makes a dollar on average through the cycle and maybe makes whatever, $2 at the peak. So what happens? Well, when we're near the peak, people kind of realize we're near the peak, but they still overvalue it. So maybe they'll value it at, I don't know. So maybe let's say the business should be worth $10 times a dollar of mid-cycle earnings. And they will overvalue it and let's say pay 18 or whatever it is, based on peak earnings. Then the cycle will unfold. And here's how this is going to play out. A bunch of sell-siders will say, well, let's wait for the inflection point. So they're trying to time the inflection point. We want to have visibility, which, by the way, most managements will do that as well, as far as not suspending their share buybacks, and then they'll say, well, there's limited visibility, guys. We'll wait for a little bit more visibility. Well, when you get the visibility, you'll have a different price, but that's a different conversation. So the stock goes to $5, right? It goes to $5 because right now the company is earning between zero and minus $1. It's losing money, or maybe just not making any money, and people are just waiting for the turn. So this business that's worth 10, you can buy for 5 if, and this is an if, you're willing to buy before there's evidence of an upturn. Now, the whole key here is the correct diagnosis of the problem. So if it's truly a cyclical problem, it's a matter of if, not when. Sorry, when, not if, right? Because by definition, the cycle will turn. And the only other corollary is that you can't have what I call something that's a path-dependent cyclical. And that usually arises when the balance sheet is just not strong enough to withstand a particularly prolonged or deep cycle. So it means that in a benign cycle that's shallow or quick to recover, we're going to do okay. But if there's a deep or long cycle, you're going to go bankrupt or need to raise dilutive capital. So as long as that's not the case, we're talking about when, not if. And if you buy something for half of what it's worth, even if it takes 5 years, it's going to be a 15% CAGR. But again, this is predicated you diagnose the problem correctly, and this is not an internal problem, but this is a cycle which will definitely turn. And this pattern reoccurs every single time because people want to wait for the inflection point of the catalyst. And sure, by the time you get the catalyst, you might get a price of 9 or 8. And so I think that you can make very good money, and it's a very basic pattern they teach because it's very simple to analyze it because there's less work required than some more advanced concepts we can talk about later.
So just to be clear, Gary, I think you're in the same camp as I am on this issue. It is simply you don't wait for catalysts. In other words,
With this, now with the cyclical, and because the reason with the you don't wait with the cyclical is because you know it's if it's a cyclical, it's going to turn. Whether the cycle ends in 18 months or in 6 months or in 36 months, that will affect your CAGR. But if you buy based on the price to value relationship and that margin of safety is sufficiently big, your CAGR, which is the ultimate goal, is going to be fine. Now, if someone buys late, let's say they buy at 8 in that example for a company that's worth 10, and then they sell early, let's say they sell at 10 or 11, and it takes them a few years to realize that that's a problem because their CAGR now is not that good. But if you buy at the point of maximum pessimism, as I like to call it, or close to it, you will do very well with no catalyst in the cyclical.
right? And just for our listeners, when Gary's saying CAGR, right, he means your annual return, cumulative annual.
Yeah, your IRR or your annualized rate of return, because obviously the two determinants are your total return over the period and how long it takes. And the longer it takes you to realize the same rate of return, the worse you are. I mean, my wife's grandfather, who recently passed away at the tender age of 105, used to tell us the story of he always all his wealth was in Disney stock. And he would say, Gary, do you know what my cost basis is on this thing? And I would say, no, tell me, Grandpa. And he'd say, well, it's $8 per share or something like that, right? And then, as I said, he was 105. So at one point, I did the math offline from when he bought it, and the compound annual growth rate was like 8%, some high single digit number, right? But look, I didn't have the heart to tell him. It's not like next time I saw him at the family gathering, I didn't tell him, well, Grandpa Sam, nope, you didn't do so well as you thought. I didn't. I kept that to myself. But I think the point of the story is it's not just the total return; it's how long did it take to achieve it.
Right. So you have been in business since 2016. What is your average hold since then?
My average holding period.
Yes, your average holding period. Sorry. Yes.
Yeah, no, sure. I mean, I don't have the actual number. The last time that's current. The last time I checked, it was about a 25% annual turnover, which means a 4% 4 year holding period, and that's about right. Meaning that if you think about it, I think it was Seth Klarman or someone similar who came up with the idea of the yield curve for equities. The idea being that the short term of the curve or the 6 to 12 month time horizon stuff is fairly efficiently arbitraged by most market participants. And as you go beyond that 18 to 24 mark, very few people are willing to take the short term pain. Like if you were to take some average portfolio manager at a big institution and you came up to them and said, here's a proposition for you. You're going to have, a compound annual return on your investment of 20%, but the first 2 years will be negative. Would you like it? Many will say no. And they'll say, well, Gary, I'm just going to wait for the third year. I'm no fool, right? And the problem is that in the markets, you don't always, it's not as clear cut as that. The point is, their bonuses might be in jeopardy, their jobs might be in jeopardy, they might lose clients, whatever the case might be. So people want the returns this year, right? Or at least in the next 18 months. And so I think that by going out beyond that, you get to a much more inefficient part of the market. But the other kind of thing I want to kind of maybe push back on a little bit is that there's some value investors running around saying, well, I'm a buy and hold investor. I'm going to buy this amazing company, and I'm going to own it forever. Well, that's not value investing anymore because the refutation is simple. Well, if it were $1 million per share tomorrow, would you still own it? Oh, well, not a million. I mean, no, well, then it's not forever. So it's either you're holding it forever or it's price dependent, right? And so my decisions of whether to own something or not are a function of the fundamentals, business quality, the earnings and cash flows, management quality, balance sheet, and the price. And if at any point, so while my average holding period is 3 to 4 years, if at any point someone offers me what I consider to be an attractive price, or if there were a much better opportunity in terms of opportunity cost that came about, I might make the switch. It just so happens that given my approach, a few years is my typical holding period.
I see. So this aspect of your style that you've described sounds like very classic value. You know, it almost I seem to remember Ben Graham saying something like, 2 to 3 years is pretty typical for for a position for him, and you're at about 4, so just a little bit more than that. But you're concentrated, and that make doesn't I mean, doesn't that make for more stress on you to have concentrated
Well,
positions?
I think that's exactly right. That's exactly right. And so, when so like I know we started this conversation with kind of you jokingly saying all us value guys sound alike. Let's talk about behavioral stuff, which I get it. I'm not teasing you at all. I think like I read some people's letters. I'm like, wait, I could have written that. Like, right. So, what is the difference? And I think part of the difference is temperament. But Warren Buffett always talks about that. You can't teach temperament. It's like think wouldn't know some other famous basketball coach said, I can't coach height, right? So I can teach almost anyone how to model in Excel. That's not hard. There are many ways to over a few years learn how to analyze the business qualitatively, Porter 5 forces frameworks and so forth. And some people are going to be better, some people are going to be worse, but it's teachable. Temperament, I believe, is not teachable. Like what is? So I'll give you an example. Used to have a boss at one of the big firms I worked for, and he supposedly was a value investor who ran a value fund. And every time a stock sold off, his natural inclination was to sell. Now, sometimes he was able to get a grip on himself and not do that, but that was his natural tendency, which, by the way, is very common. And every time a stock was going up, his tendency was to add to it. There's nothing wrong with doing either in selected instances, but if you're wired to be afraid and act afraid when everyone else is as well, it's very hard to have an independent view that's not a function of the opinion and the action of the herd. And that's so temperament. And by the way, temperament gets tested at intermittent intervals, but those are very important. Like we're in one of those periods right now where we had a lot of investors who, for a decade, were picking stocks from a universe that had a 20 to 25% annualized rate of return. And some of these investors are extremely skilled and good. I don't want to paint with overly broad brushstrokes, but not a lot of these investors, frankly, were just gamblers. They were picking from a highly biased universe, but they convinced themselves and others that they're amazing stock pickers. And they ran around and talked about their fancy mental models and how they buy compounders irrespective of price, and they're that good. And look at Costco or some. You would point to other successful practitioners with that style, and there are some very successful, but a lot of people have basically just gambling on garbage bubble stocks, and they got lucky, and then the luck kind of ended. So far this year, we'll see where things go, and some of these folks are staring at 30, 40, 50% losses, right? And that's when the temperament gets tested, because it doesn't get tested when you're telling your LPs, your partners or your clients, oh, another 30% year, look at me, I'm great. It gets tested when you have your minus 50% year. Now, as a deep value investor, I hopefully shouldn't have minus 50% years, but sometimes, who knows? It's not within 100% within your control what people price the securities at. But I think tolerance for pain is, and also just combined with behavioral models to be very process oriented as opposed to outcome oriented, is one of my big competitive advantages for sure. And that it does allow me to have concentration, because I know myself from my 2+ decades of investing that when the pain comes, I'm going to stick to my process. That's what I pride myself on, not whether one stock went up or down, or whether even if I made a mistake or not, because I am going to make mistakes. So will everyone else. The point is, over time, what's the net balance in terms of magnitude and frequency of your mistakes versus your good decisions?
Amen to that. I think enough folks don't, especially early on, especially if they're not professional investors, they get a mindset where they think there's a system out there that's gonna pick, winners every time, and we know that
Mhm.
doesn't exist. Um,
Sure does.
so
I think the name was Bernie Madoff. I mean, he had a system like that, right?
that's right. Yes, the system that picks winners every time is a fraud. That's right.
Hmm. That's right.
All right. So we're actually we're near the end of our time here, and I want to thank you for being here. But I do have my final question that I want to ask you, and it is the same final question for every guest on the podcast, no matter what the topic is. Even sometimes we deal with a non-financial guest every now and then. Same exact final question, and that is simply if you could leave our listeners with a single thought or a single idea today, what would it be?
I would say humility. I think that you want to be humble in this business, and if one of my mentors, a gentleman by the name of Joel Tillinghast at Fidelity, who I learned a lot from in my early days. I remember going to lunch with him and asking him, Joel, how did you pick your style? And Joel was hired by Peter Lynch, and and he went on to have an extremely successful career. I think he's beaten the market by 4% per year over a quarter century, managing tens of billions of dollars. So extremely impressive. And he told me something that really surprised me at the time as a young analyst. He said, he said, I didn't know if I could be a good stock picker, so I picked an approach that didn't rely very much on predicting the future. And I kind of didn't get that, because I was like, well, isn't stock picking what we do? What do you mean, not sure if you're a good stock picker? And what he meant is he wasn't sure he was going to be good at predicting when businesses are going to achieve drastically new and better things than they've ever done. And his based his approach on being humble and just finding situations where things were gonna were predictable and steady Eddie, and maybe people they weren't the most glamorous companies, but the prices were really cheap and the businesses were good. They might not have been great, but they were good, and the people were honest. And he made a killing. If he, by the way, if he had 4% of excess return per year, managing tens of billions, you can only imagine what he would do with a much smaller sum, right? So, and I think that was an approach based in humility. And so I try to do the same thing, and I would advise the listeners to do so as well. Is to, if it turns out that you're Michael Jordan of investing, and that's great, maybe you can pick the compounders in your price, but very few people can do that. So that's an approach that kind of is the opposite, based a little bit in arrogance. Sometimes it's deserved arrogance, but still arrogance, meaning I'm going to take something which very few people can do well, and I'm going to be one of the few people to do it. So I think investing is hard enough. So I would say base your approach on humility, and then work really hard from a position that you're going to be wrong a lot, and build that being wrong into everything, into security selection, into portfolio construction, into how you build the structure of your firm, into which clients you choose or not choose to partner with. So humble but confident. Humility is not the opposite of confidence, So I think can be humble and confident at the same time.
Humility and confidence. That's a good combo. Thanks. That's a good answer, man. So, listen, thanks very much for being here. I really enjoyed talking with you, and I know our listeners enjoyed it as well. So, thanks again, and I hope you'll come back in 6 or 12 months and talk with us again.
Would love to, and thank you again for having me on. And hope everyone out there is enjoying themselves and staying safe, both in the world and in this crazy market.
All right. Well, I enjoyed that very much. I hope you did too. The reason why I invited Gary here is because I've heard him speak. We see each other every year at an investment conference that I just got back from in Vail, Colorado, and I see him speak most years, and he is obviously very, very thoughtful on the topic of behavioral investing. And I was really excited and interested to hear how he turns that into a tangible, sort of doable quarterly process for assessing whether or not his thesis is correct or not. Um, I think that's really quite a bit of self wisdom being exercised there. You know yourself well enough that you need a system just to make sure that you are or are not on thesis with your investment. I thought it was quite brilliant, and And you tell me right into feedback@investorhour.com what you think. But I just feel like we've heard so many times, people say, I like high quality businesses. We like plenty of free cash flow and good balance sheets and good margins. And, we buy at a discount. And we've talked about all of those things many, many times. We have not talked about anything quite like this very often at all. And certainly, I can't remember hearing a rigorous process to work the behavioral aspects, into the investment process like we heard today. So really valuable. Wow, that was great. All right, let's take a look at the mailbag. Let's do it right now. Look, I think you know by now, I'm always trying to tell you the really hard truths, even when, especially when, what I have to say is unpopular. Today, the hard truth is that your wealth is in danger. Everything you may have made in the bull market of the last decade could disappear very quickly. Some of it's probably gone already. This process has already started, and even if the financial markets somehow avoid a devastating crash from here, inflation is still eating 8% of your money every year. I've spent 20 years helping people prepare for extreme market shifts, just like the one we're going through right now in my role at Stansberry Research. I've recommended 24 triple-digit winners, and I called the collapse of Lehman Brothers with near-perfect timing. Well, today I'm issuing my biggest warning ever. If you want to preserve your retirement and your lifestyle in the coming years, you need to act. I recently went on camera to lay out a simple one-step plan for what to do. You can set yourself up in minutes and likely forget about inflation, rising prices, or the worst effects of a market crash for years to come. This plan does not involve options, shorting, crypto, or anything complicated, and it doesn't require perfect timing. The perfect time to act is right now, and you could see triple-digit upside in the coming years. To watch my full interview with the brilliant financial journalist and hard asset expert Daniela Cambone, simply go to www.crashprotection2022.com. Again, that's www.crashprotection2022.com to watch our full interview for free. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Send questions, comments, and politely worded criticisms to feedback@investorhour.com. I read as many emails as time allows, and I respond to as many as possible. You can also call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. Lots of stuff about gold this week. Let's dive in with Michael L. And Michael L. says, with the high level of inflation driven by increasing the money supply relative to goods and services available, and probably understated substantially, according to shadow stats, does this distort any of the metrics that lead us to conclude the market is overpriced? How did markets in extreme examples of inflation respond, Weimar Republic, Zimbabwe, Argentina, etc., relative to their non-super hyperinflation historical averages? What about periods of very high inflation in the US or other advanced economies? Do these metrics work as a valid measuring stick when something fundamental like this occurs? This is important to ask and challenge, especially at Stansberry. When to buy, not overpaying, is critical to long-term investing success and the recommendations. I ask this also in the backdrop of understanding the value of a commodity. I look at gold right now. For years, I've heard this is important to understand how gold is priced. You can look at it in comparison to the S&P, silver, dollar, euro, etc. With the dollar having strengthened significantly over the last 6 months, is gold really down in value? I think it is. Or I don't think it is, he says. Inexplicably, we seem to have an opportunity to buy more of it with the dollars we have. Hope you stuck with me to the end. Love the show and the work you do. Keep it coming. Regards, Michael L. Michael L., first things first, those hyperinflation examples don't apply. Hyperinflation is a totally different phenomenon than the 9% or greater CPI type inflation that we're living through now. Hyperinflation is a societal breakdown. It's it's not just more currency relative to goods and services. It's much worse. I mean, if hyperinflation is happening, um, you got bigger problems than like whether or not stocks are a good buy. And that's when you want to that's when you want to own plenty of guns and ammo, and maybe even a place up in the hills or something. Okay, so let's just get rid of all that, um, and replace it with the main example, of the past 50, 60 years, which was the 70s, right? So if you look at a long-term chart of the S&P 500 PE ratio, you can see a dip in the 70s. And it makes sense, right? I mean, if you got a phenomenal business and it reliably generates like 30% returns on equity year after year, and inflation is 10%, that's 20% on equity. And if at 30% ROE, the thing is worth, just keep the numbers simple. These are just hypotheticals. They mean nothing. It's just for example purposes. But if at a 30% ROE, people say, well, this business is worth 30 times earnings. At a 20% ROE, maybe it's worth 20. Maybe it's worth even less because people are just worried in general, right? So, yes, inflation means multiples darn well ought to be lower. And that's one important reason why they have come down. But as I said in my rant, I don't think they've come down enough. So, as far as, is gold really down in value? Well, yeah, it is. Um, but over the long term, it's done a brilliant job. It's still going to do a brilliant job. It's crushed everything else, in the past 6, 8 months. And I agree, we do have an opportunity to buy more of it right now, and gold stocks too. Next comes Drew, and Drew said, I enjoyed your recent interview with Doug Casey, albeit sobering. That said, one of the concepts that you discussed was the redefining of the word inflation, essentially the increase in the supply of dollars. That led me to two questions. Gold is not a fixed supply commodity. I watch all those gold shows and people are digging up new supplies all the time. As the gold is extracted, isn't that like inflation for gold? Won't the doubling of supply essentially lower the value of gold over time? Number two, we continue to quote gold in relation to fiat currency, most often USD. What is the relation to the buying power of the USD to gold over time? Is the price of gold really outpacing the destruction of the USD? Really enjoy your show each week. Keep up the good work, Drew. You'd think these questions had really objective answers, but they kind of don't. Um, as far as your first question, is gold being? Can we say that gold is undergoing inflation the way the dollar is? I don't think so, because gold is in relation to everything else. So we still have a lot less of that than we do of dollars, and we have a lot less of it than we do of just about everything else, right? It's a good thing that the supply of gold can grow with the economy. We talked about this when George Gilder was on the program. And he said, that's one of the problems with Bitcoin is that it behaves like a closely held tech stock, and the price is all over the place because it is basically, less liquid, right? It's most Bitcoin is kind of closely held, and the rest of it trades like a meme stock. It's crazy. And it doesn't behave like a currency at all. And it doesn't behave like a store of value at all. That's objective. You can't argue with that. It absolutely has been the way it has been. Um, and as for gold, it's beaten stocks in the 20th century. It's a 50 bagger since it was divorced from the US dollar in 1971. So over the long term, it's done a brilliant job. And people right now are going to say, well, look at Bitcoin. Since its inception, it's up, 30,000% or whatever it is. I don't know what it is. So that's the same thing, isn't it? Well, all I'll point out to you is things that go up 30,000% tend to fall 90%, as Bitcoin has done in the past. And I think it'll do it again. I think that, it peaked at around 69,000, and I think the bottom is somewhere between 3,000 and 12,000 still. And it has yet to be proven. Gold is proven over 5,000 years. You know, Bitcoin hasn't even had 15 years to prove itself. So let's just not get ahead of ourselves with Bitcoin as a store of value or a currency. Your second question was, we continue to quote gold in relation to fiat currency. Is the price of gold really outpacing the destruction of the USD, and what's it like over time? I think I answered that already. Um, Good questions. We should question these things. Thank you, Drew. Next comes Zach R. Zach R says, "Hi Dan. One of the things I've been wanting to see this year is a capitulation day. I don't expect to see a 12% down day like we had during COVID, but maybe something 6-7% on the S&P. The worst we've seen is just under 4%. Bank of America's fund manager survey shows equity allocations at the lowest level since the great financial crisis. Survey also has cash positions at the highest level since 2001. Growth peaked more than a year ago, and many speculative names have seen 70 to 90% declines. Have we already seen capitulation? I would love to hear your thoughts. Thanks, Zach R. Um, well, the final capitulation, no, I don't. I don't think we have. I don't think you come out of one of the three most massive bubbles ever of the last century, and by a couple of measures, the most massive bubble ever. Certainly the most massive bubble in bonds, right? With the 10-year was 0.5% a couple years ago. So, um, wow, yeah, crazy, right? And that was basically a 5,000-year high in bond prices. If you read the yield book, Sidney Homer's yield book. So yeah, most massive bubble ever, and we're going to get out of it with a little 30-40% or 20-30% drawdown in the S&P and NASDAQ. Yeah, I don't think so. So I don't think we've seen the ultimate capitulation. What happens in between, the top and the bottom, is going to be a wild ride. We will get major rallies. So yeah, that's my thought, Zach. We also have Elsa G asking about gold. She said, would it not be more correct to say that gold has done very well this year compared to stocks despite the rising dollar? In other words, would gold not do even better if the dollar rolls over? Well, yeah, absolutely. I agree. Because that strong dollar is in relation to other currencies. That's how it's being measured. And somewhat in relation to gold, but gold's held its own. It's done pretty well relative to stocks and bonds and other things. Finally, we have Al M. Al M is a longtime listener, frequent correspondent, very thoughtful, intelligent guy. Always, he sends longer emails, so I tend not to read them. But this one is good because he's basically ranting back at me a little bit. I mean, he's I don't think he's really sort of taking a dig at me, but I like the tone of it, Al. I like this. I like when you're on fire here. It says, Dan, it seems to me that you two, meaning Doug Casey and I, give the current Fed chairman and current politicians way too much credit for being stupid or just plain dumb economically. It seems you do this on every issue. Really? He says. Why do they have open borders? Why do they kill millions of businesses? Why do they supposedly believe in some professor, Stephanie Kelton, who claims that you can print money to no end with no consequences until inflation? Oops. Why do they lower rates and keep them there for years? Why do they hate energy companies and energy for everyone? They want energy only for their personal jets so they can fly to big climate change meetings and conjure up new tax schemes, even though their own scientists claim they're distorting all the data for their narrative. And then he refers to Steve Koonen's book, Unsettled, which I agree you should refer to it. It's all in the title. The science is unsettled. Science is never settled, ever. He continues, I think they know exactly what they are doing and understand exactly the economic consequences. They want to kill capitalism. They want a new world order based upon a few elite choosing everything for everyone, and they think they will be part of that team and the billionaires club. They think they're already controlling everything. They are already killing capitalism as sure as I have a nose on my face. Al M. Al, you rock, buddy. I like the way you're thinking. They couldn't be this stupid. I hate to be a conspiracy theorist, but the problem is they keep coming true, these conspiracy theories. Yeah. Let's hear more of that, Al. I like it. I like getting you fired up. All right, that's another mailbag, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want me to interview? Drop me a note at feedback@investorhour.com or call the listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.